Welcome to Business and Wealth Strategy. I'm your host, Karen Newton, and today I'm going to be looking at the rising strain on Hong Kong property loans. Now, you may be wondering, if you're in the UK or in Europe, what does the strain on Hong Kong property loans have to affect me? Well, the truth is that we're now in a global economy. So what happens in other parts of the world actually affects our day-to-day lives. And there's some concerning things coming up around the Hong Kong property loans market that could have a flow-on effect through the banking sector globally. So what am I talking about here? Recent headlines claimed $35 billion of bank loans at HSBC Hong Kong. But that figure isn't supported by the data. The truth is subtler, yet far more telling. Hong Kong's property market slump is squeezing bank balance sheets. It's exposing credit fragilities and testing regulators' ability to contain contagion. This commentary corrects the record. It explores what's really happening inside HSBC Hong Kong loan book and maps the early warning signs for investors, entrepreneurs, and policymakers watching Asia's financial pulse. So let's look at what the headlines are versus the actual facts. So the headline claims 35 billion of bad loans. The data doesn't form part of any official filings. But what is verifiable though is Hang Seng Bank, which is 63% owned by HSBC, reported 3.2 billion in impaired property loans. Now, 3.2, okay, that's still quite a bit, but compared with the volume of money these banks deal with, it's not a great deal. But the concerning aspect of this is up 85% year on year. Now, the entire Hong Kong banking system holds around 25 billion in non-performing loans. And that is at a 2-decade high. And when we look at HSBC in particular, remember this headline that they have 35 billion in bad loans? Well, they have 32 billion exposure. That means that's what their lending is. And of that, currently 73% is being flagged as elevated credit risk or impaired. That means roughly, when you put all of this together, 23 billion of HSBC Hong Kong commercial real estate portfolio sits in the higher risk zone. So let's go back in history and let's have a look at why this panic mode, if you like, with some of these headlines. The comparison to 2008's UK subprime crisis is actually quite natural. Both involved property-backed loans, leveraged banks, and investor nerves. But while there are echoes, its underlying mechanics are fundamentally different. You see, what happened with the subprime crisis is that in the early 2000s, US mortgage lenders issued huge volumes of subprime loans, mortgages to borrowers with weak credit and little verification. These loans were packaged into mortgage-backed securities and sold globally. When interest rates rose, home prices fell, default spiked, and the mortgage-backed security market collapsed, triggering a chain reaction. Investors couldn't price risk, interbank lending froze, and major institutions like Lehman Brothers and AIG failed, leading to a global credit contraction. The contagion wasn't just about bad loans, it was about the opacity and leverage in the financial system. So when we look at the Hong Kong situation, that is different. Its problem is concentrated in commercial property valuations, not residential or subprime mortgages. The loans are to corporate developers, property investors, not mass real retail borrowers. And unlike 2008, these loans aren't being repackaged into opaque derivatives. They largely sit on the balance sheets of the banks that originated them, making risk visible and measurable. Now, the other thing is that the banks have been subject to a lot of regulations since 2008. And when the credit crunch occurred, tier 1 ratios for big banks were around 8%. Today, Hong Kong banks hold tier 1 ratios above 17% and total capital ratios around 24%. So there is a bit more stability within the banks, a bit more flexibility to be able to deal with bad debts. The Hong Kong Monetary Authority and global central banks now have playbooks from 2008. Liquidity tools, swap lines, and coordinated interventions can be deployed far faster if cracks widen. Now, that doesn't mean that banks aren't going to fail, because they will, but it means that the authority can step in and try to reduce the impact of what is happening within the market. So, what could still go wrong? Well, even with stronger safeguards, the risk is in feedback loops. So, for instance, a prolonged downturn in property values gives falling collateral, higher provisions, tighter lending, and slower growth. Now, that can't create the 2008 style meltdown, but it can still drag on profitability, liquidity, and market confidence across Asia's banking sector. And because we're in a global economy, our banks are all interconnected. So if something affects Asia's banking sector, then it is likely to affect other banks around the world. So Hong Kong's property market, it's not just a local story for Hong Kong. It's a barometer for global liquidity and risk sentiment. The numbers show resilience for now, but with 73% of HSBC's commercial real estate loans in the risky zone, this is no small signal. So whether this becomes a controlled cleanup or a regional ripple depends on how fast banks can work through these loans without triggering fire sales. So this one has all the hallmarks of creating an investment cycle turning point. Not the calamity that we saw in 2008, but certainly turn the investment cycle, trigger a downward trend. But for investors who have better knowledge and better skills, this presents opportunities. Stay tuned for further updates on this, because this is an interesting developing story. that could have wider ramifications. Disclaimer: the information shared in this podcast is for educational and informational purpose only. It is not intended as financial, investment, legal, or tax advice and should not be construed as such. I am not a licensed financial advisor, and the strategies discussed are based on my personal experience and my general market knowledge. As always, do your own research and consider your individual financial goals, risk tolerance, and personal circumstances before making any investment decisions. I strongly recommend that you consult with a qualified financial advisor or licensed professional before acting on any information received in this podcast. Investing involves risk, and past performance is not indicative of future results. By listening to this podcast, you agree that the host and associated entities are not responsible for any losses or damages arising from your use of this content.